Now, Paul sent in some questions, and Paul's questions seem long, but when I read it a little bit more, it was kind of easier to see. So what I'm going to do is read the email that Paul sent to me real quick, and then we're going to break this down. And Paul said, as I observe unusual long call activities and listen to options traders, I've noted an absence of discussions about exit plans for long call positions. One thing I didn't mention to Paul, of course, is in the Power Options Webinars archive, I have a full presentation on managing your long options positions, calls or puts. But we'll show that in a moment. Paul says the typical reported trades are for calls with strikes out of the money. From a historical viewpoint, the probabilities of these calls going in the money are usually small, say 10 to 30%. Right, makes perfect sense if it's out of the money. Either the trader is speculating that the moves will be unusually high or has found from analysis there's a way to profit without going in the money. Well, to answer the question quickly, sort of, that's correct. They're not planning on it going in the money, Paul, and I'll show you why very soon. And it says some traders report that they buy an even number of calls, 2, 4, 6, keep it an even number. So when the price of the call is doubled, then they sell half the calls. Well, this practice reduces or eliminates the risk of the original investment. There is no explanation on how to exit from the remaining position of half the calls. Okay, that's the second question on exiting. Some traders report they respond to an increase of price by selling calls against their original long call positions, but I have not heard traders discuss their exit plans for this strategy. All right, well, we're going to take a look at that. First, let's take a couple minutes just to break down what I emailed to Paul. Okay, so first, regarding deep into money calls, they're a collection of long call traders, and someone even has a course out there that buy cheap out of the money calls with expected win rate of only 30%. I don't mean return on investment. I mean they expect to profit only 30% of the time. Now, they're not expecting the position to be in the money. What they're doing is essentially hoping to see an increase in the price so that call that they purchased, which might be 10 cents, 20 cents, or 30 cents, if the stock moves up $1, that call might now be worth 40 cents or 50 cents. They could sell it for a 100, 150% profit. What they're doing is hoping to flip the win-loss ratio on what you'd see with out-of-the-money credit spreads. So if I only lose a small amount 70% of the time, but make 100 or 150% return 30% of the time, am I going to have big success? All right, so what are we saying? Is it best to take a credit spread approach? Is it best to take a credit spread approach where I'm right 80, 85% of the time, and I average 15% leverage return on my credit spreads when I'm right, and I close them out for only 50 or half the percent loss when I'm wrong? Or is it better to be right 30% of the time making 150%, but lose close to 90% when I'm wrong the other 70% of the time? Well, let's go ahead now and take a look. We're going to navigate over to radioactivetrading.com, and we're just going to go to the Resources tab here at radioactivetrading.com and click on the Trade Simulator tool. Now, you've all heard me talk about the portion of my portfolio I use for the bull put credit spreads, and my average is the numbers I just showed you. When I'm right, my average return is 15.1% return, and on the losers, I try to keep that under 50%. It's usually about 48.1% is my average. But my success rate is about 83%. And I'm going to diversify here. I'm going to take $10,000, but I'm going to open 3 trades. Okay, so I'm only going to allocate 33% to each one of those trades. Now, if I'm not right 82, 83% of the time, I don't have a good track record. I know this. Okay, here we are at a loss about 37% on the portfolio, being right even 76% of the time. That's the nature of spread trades. Let me get a good one here. There we go, 83. So at some point I might have gone negative here depending on the strings and losers over 100 trades. But eventually, $10,000 might have gone up to 33,000. So, or, let's call it 30,000. So I made 20,000 on the 10,000 invested. 200% return, or what might be a 20% return, because I'm really only going to make sure I'm allocating 10 or 15% of my total portfolio to spread trades because of the wild swings we potentially could see. Okay, so can I beat this? You know, you're seeing 83% of the time taking 10K up to, let's call it 30K with these numbers, right? 83% of the time making 15% when we're right, limiting it to 48%. Well, what did I mention? This out of the money long call approach might be looking for 150% when we're right. Kind of trying to take only a 90% loss when we're wrong, but we're only going to be right 30% of the time. We take a third of allocation into there. What do we see? Didn't quite make it, did we? You got bankrupt after 70 trades. Close, but not quite. Bankrupt after 17 trades. Okay, bankrupt after 30. What needs to change here? Well, you might see a 200% gain. You might expect that. That's a possibility. Let's up that to 200. Are we going to get better? Bankrupt, bankrupt, no. What has to happen? Let's say my target is still 150% gain, but I'm going to control the losses to 50% and still be right only 30% of the time. Here we see almost the same numbers. We took that $10,000 up to $32,821. But what happened in between? A drawdown of 73%. That makes sense, doesn't it? This is very sort of risky, speculative trading. Doesn't matter that the option only costs 10 cents, right, or 20 cents. The win-loss ratio is that you have to expect that when you go wrong, you're going to have to close that long call for 5 cents or so just to not take 100% loss, even if you're making 150% on the position, on the winners. And 150% isn't a lot, is it? You know, buy it at 20. The stock moves up. I sell it for, let's say, 45 cents. I'm sorry, not 45 cents. It'd be about 50 cents, right? Make 150% profit, 150% profit. But you're right. You might only be right 30% of the time. And I have to be right 30% of the time. Let's get to 29. Nope, bankrupt. 35. You know, when you get to the higher numbers, you're looking phenomenal, but you had to withstand a 45, 55% drawdown. 29. Didn't make it. 29% wins. Eventually, you did take it up to 13,000 at one point, but it didn't pan out. 27, 33 again. Let's see if I get to 32. I know I'm clicking randomly, but I'm just, there it is, 32. Not as good of a return. You see how quickly this goes against you. It's very speculative and very dangerous. And that's assuming, this is assuming, Paul, that I can control those out of the money cheap cost losses to only 50%. Bought a call for 20 cents. As soon as I see it at 10 cents, I've got to close it to control my loss to 50%. It's a tough one. It's really tough, and we're going to talk about that in just a moment. Okay, so I already reviewed this here. I created these slides on the fly today, so what I failed to do is memorize what comes next. But what did we see? Well, in order to be successful, even when you went with the higher target return from 150 to 250, assuming you got 250% wins average with the speculative out-of-the-money approach, you still didn't get the targets right away. You have to cut the losses probably to about 50%, especially if you're doing shorter term trades, 2 weeks out, 1 week out. Problem with that is that you could be at a 50% loss on the day that you open the position, just based on bid-ask spread or more. Hopefully you get filled at midpoint, but if there's a subtle change during the day, you might be at that 50% loss. This might mean you're closing more and you're not allowing the positions to stay open for a gain. On a side note, let's be honest. Without the track record for me to even explain or what their track records are of the people who are talking about these out-of-the-money options, most investors I know would not be happy buying into an idea where you're only going to be right 20 to 30% of the time, 25 to 30% of the time. No one likes to see that. I'm wrong 70% of the time and I make money. Well, I guess if you're making money, that's okay. But again, aren't there better structures to do better potentially without having to find yourself, forcing yourself to pick those winners and watch the market consistently to be right 70% of the time? Okay? Now, okay, just scrolling through something real quick here. Okay, good. So now, on the exiting, When the price of the call is doubled, they sell half of the calls. Well, this practice reduces or eliminates the risk. I can almost have a no-risk long call remaining. Absolutely. There is no explanation on how to exit for the rest of the position. Well, my initial response to this is that, if I cut the loss down by half or more, so we saw what we needed to do, that you would need to probably control those losses to be 50%, half of what you invested in order to profit long term, even with 150 and a 200% gain averaged on your winners 30% of the time. Okay? So the answer is, how would they exit it? Well, let's say we cut our risk down from 90 to 45. Well, now, what win percentage target would you need to meet your goals? I'm not talking about necessarily just being profitable. I'm talking about why would you be considering using this long call with a portion of your portfolio, these out-of-the-money long calls? What is your expectation of profit? And then using that simulator tool to say, hey, if I cut my losses from 90 to 45% when I'm wrong, what win percentage do I need now, knowing I'm only going to be right 30% of the time to hit my target profit? Is it 130%? Is it 120%? I don't know off the top of my head. We could run these simulations all day. Okay, so, but what did we see? You saw that when we shifted the losses, we were able to hit targets similar to what we saw with the bull put credit spread ranges. Okay, but are those your profit targets? And is it, again, it comes back to this question, is it best to exit these out-of-the-money calls when they hit a 50% loss? Or is it better to take closer to a 90% loss, hoping they recover and that you can get that 100% gain? And then what target percent gain is close to match the goals? See, I can't answer the question for you as to how would I exit it after that, if once I sold the long call, I sold half the long calls, Paul, because it depends on how much risk I still have, what are my average losses still over time, and what is my trading plan and target goals for this strategy in my portfolio. That way I can determine when I would exit it. What percentage gain on what I have remaining is my target. Okay? That's what the simulator helps you do. It helps you set the targets based on what your expectations are. Now, I'm not going to just babble on about this. Let's talk about some examples. We're going to navigate over to Power Options. We're going to take a look at three examples to show what management might be used, what are the pros and cons, why these long call investors specifically are not necessarily looking for the call to go in the money, and then maybe discuss the pros and cons of management. All right, so back to Power Options we go. And what I want to do here is navigate over to the portfolio tools. And Paul, here's the situation I created for today. Yesterday, HOME, low price stock, was trading at about 650, I think, 642. 650, I'm sorry, 650. The September 7 strike call was trading for 25 cents. Okay, so it doesn't seem like a lot, but in essence, it's about 8-9% out of the money, isn't it? It's a smaller price stock, so any move upwards. I could have taken the 8 strike call, which would have been about 7 cents at midpoint. But we're going to use the 7 strike call, for example, 25 cents cost basis. Today, the stock moved up 72 cents, roughly 11%. And it is in the money at this point. Okay, the stock did go over the strike price, and now it's doubled. Some of that's intrinsic, some of that's not. But the other strike call, the 8 strike call that I could have bought for 7 cents, is right now priced at about 18. So because the stock moved up, that call that's still out of the money, it didn't need to be in the money to show a profit. In fact, percentage-wise, it's almost showing a higher profit than the 7 strike call that's now slightly in the money. Okay, so that's what they're looking for, is that if I buy something cheap, a 5 cent, 10 cent, 20 cent call, in this case it was a 25 cent call, it did end up in the money, but even those further out of the money calls are at 100, 110, 120% profit. Our gain on this call is 110%. And I bought 10 contracts. Okay, so before I navigate over there, though, let's take that other example. Urban Outfitters. Yesterday was priced at about $24.70. Dropped 87 cents today. Doesn't seem like that much. But the out-of-the-money call the 27 strike call when the stock was about 24.70, which is priced at 15 cents, is at a loss of 66% with only an 87-cent decline. Okay? That's what we're talking about here. Did I keep this to 50%? Nope, it's beyond it. The stock drops on Monday another 40 cents. This will probably be at an 80% loss. That's a tough gamble, isn't it? But we're here to talk about Urban real quick, and we're talking about the exit strategies on your winners. Or the exit strategies on losers, Trade Simulator Tools showed us that. I've got to keep it to 50%, or I risk having to force myself to get a 220, 250% gain on average on those 30% winners. Okay, so here we are. Flash not showing. Here we are. We've got 10 calls that we bought for 25 cents. Current liquidation is 53 cents. We've got 110% return. What could I do now? Well, I could go ahead and sell half for you. We'll put in our 7 calls. We're going to go ahead and sell half, sell 5 contracts at 50 cents. We're going to take in about 250, 2,500, 262. So now I've got no risk, long calls remaining on the position. So you're going to ask me now, what is my exit strategy? Okay, well, I have no risk of leaving this position open. I'm guaranteed to make $12, right? Yeah, okay, I'm guaranteed to make $12 on the position. Original, we can call it a cost basis of $250 if you want to analyze it that way of what your return is, okay? But it does me no harm to stay in this position now. If it falls, I still make a profit. If it goes up, I'm making more of a profit. So what is the target that you need? Well, first off, what are you basing the return off of? Are you still basing it off the original investment or the fact that you have no risk on the position now? That's something you have to ask yourself. But yes, as the position continues to go up, is every position that you have going to be able to have this risk? No. 30% of the time, 20% of the time, you might get this because that's the structure. Now, what would be, even with doing that long term, what would be your average loss on the ones that you still do lose on, the ones that never get to this point where you can make this adjustment to cancel the risk? Is it still at 50%? Is it still at 45%? Are you lowering it down now because you're able to make this adjustment so the average losses become slightly lower? Hopefully, but it's not a guarantee. Why do I say that? Because 30% of the time we're expecting winners. 70% of the time we're expecting losers, and keep it to 50% loss ratio as we saw. Even if I'm able to cancel the risk on some of these 30% that are winning, I'm probably still closing 70% of the trades for that 50% loss before it gets too far away. It's unlikely that those that hit this loss would get close to the loss at 40%, then rebound to where you could cancel the risk and then come back down again. You're not going to reduce this loss. These are probably happening within the first 3 to 5 days that you open the trade. You're still losing 70% of the time. You still have to control it to 50%. So what does it mean when the target to exit? It becomes, what do you need to do return-wise to still counter the 70% losers that are losing 50% of what you invested? Okay. Yeah, and Sam does mention that when he said, was this Sam? I'm sorry. Apologize. Yeah, Sam does mention it, and we've talked about it before. When he takes 100% off the trade, or he has 100% gain, and he cuts the risk in half or by 75%, he still ends up having a loss on the position. This one just happens to be one that doesn't have any loss. Now, to your other concept that you had asked about sometimes they sell a call against it. Well, what are we doing now? Now that the stock has moved up, I got to stay in September. I'm going to sell the 8 strike call for a 1-point bull call debit spread, but I'm not paying for all of it yet. Okay, it didn't move up far enough so where I could pay for it. I'm cutting the risk in half. So I have a high percentage return, a 900% return. It cost me $1 to get in the spread, and oh, I'm sorry, no, it cost me 10 cents to get in the spread. We can make 90 cents back on 10 contracts. That's your 900% return, okay? If it stays above 8, well, what's your target goal here for if it stays between? Again, I don't know. What target do you need to still counter now that you've reduced the loss on this, right? You've lost it to 100 from the original risk of 250 to 100. Did that drop your losing ratios by selling this call on the ones you lose on from 50% losses to 25? Not likely. Because remember, only 20 to 30% of these are going to be ones where you could get to the point to sell the call to try and cut this cost in half, or to take down all of the cost to have a no-risk bull call debit spread, right? Still is only going to be 30% of the time. You're still probably losing 70% of the time. You might reduce that loss ratio a little bit, but it's not going to drop it by half, because the ones you would have lost on originally are the ones that you're still going to lose on. You're changing the dynamic of your winners, not necessarily the dynamic of the losers. That's kind of the point, is that when you see the losses with this out-of-the-money long call structure, you're still probably going to see the same amount of losses going forward. Okay? All right, so that's what I kind of want to show you with the management. Now keep in mind, one thing you could do, and I've done this before with strangle and straddle positions, is we could still sell half. And what would that do again? Remember, that would leave us with only 5 long contracts with a bulletproof position with zero cost basis, let's call it. So I'm going to put in 5 contracts with almost a zero cost basis, with a zero cost base. I could put it negative, but I'm just going to put 0. Now what happens? What if you sold half and now sold 5 calls against it? Now sold the 5 strikes against it for that 10 cents or 15 cents. Now you've got a better no-risk position with the upside. How would I exit this? Well, my hope would be that it would go above 8 and I'd get the maximum return. What is my other closing position? Well, if it falls, I'm just making that 75 cents, right? If it stays between, I'm going to be making more. Again, what target do you need? With this kind of out-of-the-money structure, knowing what your average loss is over time, knowing what your win ratio is going to be over time. Okay, that's the thing. So we see why you don't necessarily need to be in the money with this trade setup. Okay, you don't necessarily need the long calls to be in the money. You can have a strong profit if it stays out of the money as the stock moves up. We talked about selling half, sort of the pros and cons of doing that. You could still end up with a loss if you don't cancel all the risk. A winner could turn into a loser. We talked about selling a call to convert to a spread, what my targets need to be, and then selling half, and then doing the spread position from what you've been seeing. And we also saw the quick risks if the stock falls. That $24 stock only falling 87 cents puts you at a 70% loss right now on the out-of-the-money calls. So what's the answer for trading and managing this approach? That's going to depend on your goals. What are your targets for this portion of your portfolio that you're going to implement in this strategy? Trading plan. I can't necessarily develop it for you. You've got to sort of design that based on what you think is possible, what your average win target needs to be. By controlling losses in that sense to 50%, it should actually be higher, because otherwise you're going to be closing out more often than you think with these out-of-the-money calls, which defines the risk threshold. Are you willing to risk that? And this is really the same approach to any strategy. A lot of the strategies, we've already narrowed this down for you. I can't tell you about this one because I've never traded this out-of-the-money concept. The reason why? I'm one of those people that doesn't like the idea of specifically trading a strategy that's only right 20 to 30% of the time. Realizing that I need to quickly control whatever I invested into these low cost, and they'd say low risk. You're still risking 100% of what you buy into it. But I have to control the low-cost option to a loss of only 50 to 60% if my returns are averaging 150 to 200%. If I'm taking 90% losses because that 10, 15 cent low-cost out-of-the-money call goes to 5 cents or 0 very quickly, or I'm doing shorter term where I'm out of it and it's just a full loss, you saw that we probably need to be up to 275 or 300% average returns almost 30% of the time we do wins. The management, does the manager really cut down on the losers? It's hard to say. I haven't seen it in my other strategies. The company out there talks about closing your credit spreads when you've reached 50% of your expected profit. Well, in my back testing, what I found is when I do that, what I'm doing is cutting my winners short by half the return. The 15 to 14% of the time I take losses, I'm still losing. Okay, it's not countering that because the ones that lose usually start to lose right away. They don't go in the direction that I'm expecting in that situation. That's sort of the problem. Okay, it doesn't work for me with my bull put credit spreads. All it did is take my average win from 15% down to about 10.5%, which means I wasn't profitable with an 83% success rate. I needed to be 86% successful, 87% to make money, and that's not where I am. So I don't cut those winners short by doing that. Long calls is a different take. Okay, long calls is a different take, and there's no problem with taking the full, that profit off to control losers. But again, what I'm just trying to impress is what I've seen is that I'm still losing, and my bull puts 15 to 16% of the time. All I'm doing is capping my winners short. On the long call idea, trying to sell half to cut the losses, well, again, only 30% of the time you might be in a position to do that management to cut the losses down. That doesn't stop you from that as well. Okay, that doesn't stop those from still falling in to that situation. And then, of course, we got to talk about position sizing as well. Okay, so that was a lot to take in, and I apologize for that, but I wanted to cover those questions as best I could.